Andrew Economos, head of Asia ex-Japan Sovereign and Institutional Strategy at JPMorgan Asset Management, joins us this morning. We have to include the ex-Japan part, Andrew.
Yes, we did.
Yes, congratulations on the new position. Thank you for joining us today. What are you seeing in the Asia Pacific? We have had these gains basically being given up in the session. Have we hit the lows for the year?
Well, in terms of the lows, it's hard to gauge, and your guess is as good as mine. But I think what we're seeing is the decoupling story is thrown out the window. Asia has proven to be a little bit more resilient. It has proven to be the safety trade because of better fiscal and external balances. But ultimately, what happens in the developed markets, U.S. and Europe, is going to drive the market forward.
Okay,
for the next
what about the
36
jobs
months.
announcement, the job stimulus? How's that being played out here in the Asia Pacific?
Don't underestimate policymakers' intent to pull out all the stops and get the economy going globally. That's obviously good news for Asia, because if the U.S. consumer gets off its back by having jobs and being able to spend more, obviously that means a great deal for Asian exporters, which should allow Asia to make that transition away from an export-led economy to a domestic demand, self-sustaining domestic demand dynamic.
Okay, so you're saying we shouldn't be underestimating the firepower there is in terms of stimulus measures they can pull out. Does that mean in QE3 as well?
Yeah, I think QE3 or some version of quantitative easing is going to come through. The Fed has already alluded to Operation Twist, that is taking the bonds and twisting duration, if you will, going longer term. But more importantly, Chicago Fed President Evans' comment yesterday about the Fed starting to target levels of unemployment, which implicitly means the Fed is targeting levels of GDP growth. It should be taken very positively by the market.
Yeah, Evans did say he wanted the unemployment rate to come into 7.5% or so in the U.S. So that means they want GDP growth. That means more spending from the Fed, right?
Right.
So you're expecting maybe another round of bond buying as well?
Another round of bond buying, and I wouldn't be surprised if the ECB, with Trichet's comments, also initiates another big round of bond buying. Basically mop up all the damaged goods, and let's free up some of the balance sheets of the banks to try to get the economies going. Okay,
so what about this talk of recession again, back into recession? I was talking to a former Federal Reserve Vice President. He says he puts the possibility at 20-25%. Your view?
In terms of double dip?
Yeah,
I think the issue is we never really came out of the recession. You can look at the official pronouncements and say, okay, we're going into a double dip or we're not. But ultimately, the U.S. and European consumer feels like they are in a recession, if not an outright depression. And ultimately, it's consumer confidence that drives this.
You know, when you say the D word, it really scares and freaks a lot of people out.
As it should. This is an interesting time.
It is an interesting time. Those gains disappeared fast, and they disappointment from the Aussie jobs firm. But is that really it? Is that really what's happening, or just people taking profits at this point?
No, Susan, you're hitting on a very important point. Market structure, in effect, market behavior has changed dramatically. In the old days, the market used to be a price-seeking mechanism looking to allocate scarce resources to the best player to eke out a return. Now the market is all about probing weaknesses. So it's big speculative attacks on weakness as the market discerns who the strong players are and who the weak players are.
Okay, so what does that say about Australia? Does it say it's strong or it's weak with the disappointment on the jobs front, but better than expected GDP yesterday?
Yeah. It's basically what it's telling you is Australia is a two-speed economy. Anybody who's extracting anything from the earth in some shape or form is doing well and has a job, but anybody who's working in the service side or is working in financial services has a great deal of uncertainty around their future.
Does that mean agriculture as well? That's extractive.
Yeah, absolutely.
Okay.
I mean, Australia's become the breadbasket for Asia. It's a very strong argument as to why you should be there in some shape or form as an investor.
Okay, some shape or form. Do you have any more specifics in terms of what's about in Australia?
I think the extractive sectors are still very interesting in terms of their ability to produce commodities at very low price, coupled with their proximity to Asia, and as well the soft side, the commodities, in terms of the ability to produce good food that's relatively protected from pollution because of the isolation that comes from the geography. Those are all positives for Asia in terms of their move up in consumption as well as their move up in terms of uses of protein. So Australia is pretty well poised on the agricultural side.
That sounds interesting. Okay, so Andrew, what about this volatility we're seeing in the markets? Extreme, I would say, at this point, and fast. How do you play the markets? You're saying buy and hold out the window. That's old school, isn't it?
Yeah, we're not in a buy and hold market. We're more in a buy and sell market, which means the old passive way of managing money probably is no longer valid. You need an active manager who knows what they're doing, and more importantly, seek out a manager that can finally match or beat an index consistently, which is very hard to find.
Yeah, I mean, what about all these long-only funds? How do you pick and choose?
You're going to pick and choose the one that's proven their resilience in
Yeah.
the global financial crisis, 2008, 2009, good numbers.
I can give you numbers about that, though. Because what about John Paulson? He made like billions of dollars in 2008. He's losing 34% this year.
Well, I can't speak to John's portfolio. He's a smart guy. I expect he'll come back at some point. But today, this was a very rough year for him.
Yeah, this is a rough year for a lot of people. So at the end of this year, do you expect Asia to be up on the year?
I think it'll be flat to slightly up, and it'll be really a active manager's game. You'll have to pick individual sectors and stocks and bonds and corporate bonds within that, within Asia. Winners, again, as the market seeks out to gauge who's going to come out of this in best shape.
Okay, and where are the winners? Where's the best place to put your cash?
Well, clearly, I'm not going to guess at all. The market's told us quite clearly that it's Singapore. It's a good place to be both in terms of fixed income, currency, as well as equities. The market's still making up its mind on Hong Kong, but there's some quality companies with very high dividend yields that are still a very direct play on Asia growth, and predominantly China. And I think Australia probably is an interesting play as well on the soft side in terms of commodities.
Okay, what about gold? I got to ask you that before we go, because we're looking at $1,900 again.
Not too excited about gold short term. Very toppy. If you're a technician, which I tend to look at, it's a double top formation, which tells us we should be worried. Too many players are long. Who's going to be the marginal buyer always worries me.
Yeah, the hot potato at the end of the pass. Okay, so where do you think gold might drop to quickly?
I think gold is fair value, fairer value at about 14 to 1500.
Okay, Andrew, good to see you. Thanks for that.